Chapter 2, Financial Markets and Institutions. Chapter 2 focuses on capital allocation, financial markets and institutions, and stock markets with both their returns and efficiency. Capital allocation can happen in a variety of ways. One is direct transfers between savers and borrowers. Investment banks can act as a broker between these two parties, or we have financial intermediaries such as banks, which will pool the savings from others and distribute them to the borrowers without the saver knowing who those funds are going to. Capital allocation for a well-functioning economy. Capital flows efficiently, which means minimal transaction costs, and those who seek capital have the ability to obtain it quickly. So we see the suppliers of capital. These are those who have funds they wish to save or they want to invest in someone else's business. The demanders and users of capital are those who need other people's money to fund their idea or grow their business. This occurs through markets. Markets are simply an exchange by which individuals or organizations can exchange goods and services. Financial market is where people exchange funds based off of their surplus. There's a variety of financial markets, and all of these have their appropriate place in a developed economy. There are physical assets. These are anything we'd see on the balance sheet. That would be a tangible asset. There are also financial assets, which there are many billions and trillions of dollars of. There are spot markets and future markets. These relate mostly to commodities and certain other types of resources. There are money markets and there are capital markets. Money markets tend to be more short-term, while capitals tend to be more long-term. There are primary versus secondary, which is when financial securities are issued. And there are public markets, meaning all people can participate, versus private markets, which are more limited in their users. The importance of financial markets. It is essential for a well-functioning financial market to facilitate capital. And so those economies who have better developed markets perform better. They have higher rates of returns, they have greater efficiency, and a lot of this has to do with information flow and the perception of honesty. There are financial markets such as derivatives. Derivatives get a bad rap on a variety of things, but a derivative in its most basic sense is a financial security whose financial value is completely determined by some type of underlying security or asset. This is primarily used for hedging and to limit risk. So derivatives were initially created for risk avoidance and to minimize it. However, there are those who are speculators who are risk seeking. The problems with that, there are many people who may buy a derivative thinking that it is a sound investment, and it may produce a value of zero. People may lose all of their money, or if they did that on margin, they could actually owe money by the time the transactions settle. There are many different types of financial institutions. The most common one that we interact with on a daily basis is commercial banks. However, we see investment banks, sometimes referred to as Wall Street banks, financial service corporations, which could be anywhere from payday loans to finance companies to other types of banking type organizations such as credit unions, pension funds, which are retirement funds, mutual funds, which are pooling together money to invest in larger amounts and to diversify risk. So mutual funds are risk avoidance. Exchange traded funds, trying to create greater efficiency in what is traded. Hedge funds, risk seeking, but also risk mitigating. And then private equity. These are the private markets for people with a lot of surplus investment opportunity. Stock market transactions, this relates to the primary market versus the secondary market. For example, if Apple decides to issue additional stock, so this is new stock which has not previously been issued, they use an investment banker to do that. That would be a primary market transaction. However, if you or I, as an investor, decided to buy existing Apple stock, so stock that had been issued at some prior point in time, this is a secondary market transaction. With those primary markets, we would have initial public offerings. This is when the company issues stock on the public market for the first time. Any subsequent would be called a seasoned equity offering, but this is when companies go public. We most commonly see this with technology companies because usually those companies with intangible assets tend to go public before those companies who have tangible assets. It's just a phenomenon we see within corporations. Here's a graph from 1968 to 2018 looking at the rates of return of the S&P, or Standard & Poor's 500 index. And we see that most years they are positive. There are a few years we see which are negative. We see some significant negative returns. Of course, 2008 was the financial crisis, as we see the largest decline in the stock market in the last 50 years. This is an example of Yahoo Finance, of how companies are quoted for public exchange. So Twitter, which I hope all of you are familiar with. We see as of 2017, we see a decline in stock value, and so we can look at what the current market is trading it at, $15.63. What it closed at the previous day. We can see the different metrics that are related to that. Beta, an important one to measure, and we'll come back to that in a later chapter, but that is a measure of risk relative to the market. So we also need to talk about market efficiency. Market efficiency is misunderstood because there is what we call the efficient market hypothesis, and markets are not perfectly efficient. And so we need to focus on not strong market efficiency, but semi-strong or weak. And so we see here, if there are large companies that are followed by many analysts that are giving good communication to investors, so there's a lot of information flowing and it's good information, then we would have efficient markets. It would be priced efficiently. There would not be an excess return. Small companies that are not followed by analysts, that there is a lot of unknowns, there's a lot of inefficiency, and so there is the potential for greater returns, but there's also the potential for greater losses. So when we look at the implications of that, so this scenario, you hear in the news that a medical research company received FDA approval for one of its products. If the market is highly efficient, can you expect to take advantage of that? No, meaning that there was probably already information in the news that they had been seeking FDA approval, and that there was a lot of people that spoke well of the products, and so it probably was already priced in. And so if a company that was previously unknown decided to produce a product and people were not following it, meaning there were not analysts focusing on this company, then there would be a potential efficiency. We see here, a small investor has been reading about a hot, in quotations, IPO that is scheduled to go public next week. She wants to buy as many shares as she can get her hands on, and is planned on buying a lot of shares the first day. Would you advise her to do that? On average, no. IPOs do not have a great track record because most of the initial upswing is from institutional investors, and then those institutional investors sell to a small investor like that, and that's where we start seeing the decline. And so it is hard for small investors to break into that. There is a little bit of a racket with institutional investors. Another thing that we want to be aware of is what we call behavioral finance, meaning that there are irrationality and irrational behavior which influence traders, and because of that, mispricing can happen. And so being able to understand the psychology of finance is what we would call behavioral finance. And that is chapter 2.